Hey everyone, welcome to this explainer on the SBI Large Cap Fund. Today, we're going to unpack exactly how to evaluate long-term wealth builders beyond just glancing at a simple one-year return. We're taking some pretty complex institutional data from one of India's absolutely massive equity funds. We're talking nearly 49,000 crore rupees under management, and we're breaking it all down so you can truly understand the mechanics of active large cap management.
It's the ultimate question, isn't it? How exactly do you pick a mutual fund that builds serious wealth, but doesn't keep you staring at the ceiling at 3 a.m. when the market gets rocky? Well, today we're going to answer that by transforming all this complex financial data into a practical, easy-to-understand evaluation engine. We really want to see how a fund actually behaves across completely different market cycles.
All right, here's our roadmap for today. We'll start with the wealth multiplier effect. Look inside the portfolio architecture, see how it survives market volatility, decode those tricky risk metrics, do a head-to-head peer comparison, and then wrap it all up with a blueprint for long-term growth. Let's jump right into Section 1, the wealth multiplier effect, seeing beyond abstract percentages.
Okay, imagine you dropped a standard 10,000 rupees into the SBI Large Cap Fund right as its inception, back in 2006. Today, that 10 grand would have exploded into over 83,000 rupees, 83,794 rupees to be exact. It's wild, right? That right there is the absolute raw mechanical power of staying invested in large, established companies over a long horizon.
The big takeaway here is that you've got to tune out that short-term noise, because consistent compounding completely transforms your capital. Just look at the compounded annualized growth rate, or CAGR. Over a 10-year stretch, this fund has chugged along at a super steady 11.6 to 12.5%. That means 10,000 rupees literally triples to over 30,000 in a decade. True wealth building, it's not about timing some hot market. It's about consistent participation over 3, 5, and 10-year blocks.
Moving on to Section 2, inside the portfolio architecture, the structural foundation of stability.
So, SEBI rules mandate that a large cap fund has to keep at least 80% of its money in the top 100 companies. While this fund sits on a solid 85.5% large cap foundation, we're talking absolute heavyweights like HDFC Bank, Reliance, and L&T. But, and here's the fun part, they've deliberately added an 11.46% mid-cap slice. That's the fund manager's alpha-seeking tilt, trying to grab just a little extra growth. It's a strategy that perfectly balances big cap safety with a very measured dose of growth.
And this setup is totally intentional. The management team outright refuses to chase those hot, momentum-driven market fads. Instead, they're hunting for high-quality businesses with bulletproof sales growth and massive brand equity moats. They size up absolute valuations looking 5, even 10 years out to find the perfect entry points. It's an incredibly patient, valuation-conscious approach that prioritizes enduring value over short-term market hype.
All right, Section 3, surviving market volatility. Downside protection in action. Let's get real for a second and look at the late 2024 to early 2025 sell-off, when the broader Nifty large mid-cap benchmark took a serious dive. Plummeting by 18.62%, the SBI Large Cap Fund actually shielded its investors. It experienced a much shallower maximum drawdown of around 14.5%. That is the direct, tangible payoff of holding liquid, high-quality companies. They just hold their ground way better when a pan-market panic sets in.
Now, this metric is the absolute secret sauce if you're a conservative investor, the downside capture ratio. Think of it like a financial ratchet. It actively locks in your upward gains, grabbing up to 94% of the market's upside, but it blocks the worst of the hits, capturing only 88 to 90% of a market drop. Honestly, this asymmetric capture is the primary mechanical engine driving that long-term compounding success.
Section 4, decoding the risk metrics, translating jargon into clarity.
First up is beta. Think of beta as your portfolio's built-in shock absorbers. The market benchmark always sits at a beta of exactly 1.0. If a fund's beta is higher than 1, it amplifies those market swings. But a beta below 1, like this fund's 0.94, that means the fund manager is intentionally smoothing out the market's bumpiest roads. It is mathematically engineered to be less volatile than the broader market.
When we stack these risk profiles up against the category average, the picture gets really clear. A lower standard deviation of 13.85 proves it's taking a less bumpy path. The 0.94 beta confirms that defensive posture we just talked about. And crucially, the alpha, which measures the extra value the manager brings to the table above expected market returns, is at 0.30, nicely beating the category average. Bottom line, this fund generates solid value for conservative investors without dragging them through wild, unnecessary risks.
Section 5. Head-to-head peer comparison. Benchmarking against the heavyweights.
Now sure, aggressive peers like Nippon India and ICICI Prudential are posting higher 3- and 5-year returns in recent momentum-heavy markets. But don't count SBI out. They've got massive scale with nearly 49,000 crore in assets under management and a super competitive long-term stance. Plus, with a direct expense ratio of just 0.84%, they're keeping costs totally reasonable while offering a slightly different, more conservative flavor of large-cap investing than those high-flying competitors.
It really comes down to a classic investment trade-off. Do you want aggressive peers that give you those massive peak returns in a raging bull market, but leave you totally exposed to steeper potential drawdowns? Or do you go with SBI's defensive sturdiness? You might not get bragging rights at a dinner party during a massive bull run, but you absolutely gain superior downside capture and a much lower overall risk grade when the market turns hostile.
Finally, Section 6, Blueprint for Long-Term Growth, your wealth planning checklist.
So let's distill all this into a 3-step checklist you can actually take away today. First, zoom out. Always evaluate historical multipliers. Look at those 5 and 10-year blocks instead of obsessing over some flashy 1-year return. Second, check your shock absorbers. Align risk metrics like beta and standard deviation with your own personal sleep-at-night tolerance. And third, assess the portfolio's architectural bias. Make sure it actually has a mechanism for downside protection against market crashes, just like the capture ratios we dug into today.
I absolutely love this quote from the source analysis because it perfectly sets our expectations. It's a brilliant reminder that underperformance in a hot, momentum-driven market isn't necessarily a flaw. In fact, it's often the calculated price of long-term safety. If a fund lags the benchmark for a year because it outright refused to buy overheated, risky stocks, well, that's the fund doing its exact job for a conservative investor. It's behaving exactly as expected across the cycle.
So I'm going to leave you with this provocative thought to chew on as you evaluate your core holdings and plan your own long-term wealth strategy. Take a hard look at your portfolio. Right now, do you need a high-flying momentum chaser to aggressively build capital, or are you at a stage where you really just need a steady, large-cap shield against the next market storm? Thank you so much for joining me on this explainer. Keep evaluating, keep learning, and I'll catch you next time.